Hello everyone, and welcome to today's webinar, Cost of Capital Professional, Gain the Edge with New Enhancements. Our presenters today are Dr. Michael Crane and Ron Signor, whom I will introduce in a moment. My name is Adam Manson, and I am the Director of Valuation Data at BVR. We are very fortunate to have our presenters with us today. Dr. Michael Crane of Florida Atlantic University is the author of Cost of Capital Professional. He is both an academic and a practitioner. He teaches and is director at FAU's Center for Forensic Accounting. Mike also consults with clients and is senior advisor to Miami-based top 100 accounting firm Kaufman Rawson. He received his Doctor of Business Administration degree from Manchester Business School in England at University of Manchester. He has been a licensed CPA and practitioner for over 30 years and holds several certifications in valuation, namely ABV and CFA. Mike is a past chairman of the AICPA's Business Valuation Committee and has been inducted into the AICPA Business Valuation Hall of Fame. He is a recipient of AICPA's Lawler Award presented by Journal of Accountancy for Best Article of the Year and AICPA's Sustained Contribution Award. Ron Signor is co-chair of the advisory board to the Cost of Capital Professional. He is a managing partner of Senior Gustafson LLP based in Lakewood, Colorado, where he specializes in business and intellectual property appraisal, economic damages, financial forensics, professional service firm consulting, and taxation. Ron has served as Chief Operating Officer and CFO for a 50-attorney Denver law firm and worked with over 350 professional service firms on a wide range of practice management issues. He is also a member of the ABV Hall of Fame, is co-author of 3 books, and has published over 80 articles on business leadership, succession and exit planning strategies, reasonable compensation determinations, business valuation, and related subjects. Ron has developed and taught a number of management, leadership, and advanced business valuation courses for the AICPA, ASA, and NACFA. With that, I will now turn the program over to Dr. Michael Crane.
Well, thank you. I appreciate everybody being here today and taking their time out from a busy schedule, undoubtedly. For those of you who attended our session before the first of the year, this session is going to have some old and it's going to have some new. So we will be talking about some recent enhancements to the platform. We'll talk about some of the preliminaries related to valuation and so on. And a little bit later, we'll go through a online demonstration of the platform to walk you through the features, how to use it, and so on. So let me highlight, first of all, some recent enhancements to the platform. The platform now includes beta-adjusted size premiums in addition to the S&P 500 base size premiums. And I'll get into the distinction between those two in a little bit. Another recent enhancement is the addition of geometric averages in addition to arithmetic averages. So some practitioners prefer arithmetic, others prefer geometric, and the platform provides both. Another recent enhancement is the addition of weighted average cost of capital calculations so that you can develop your cost of equity and then input information about your borrowing rate, tax rates, and then the weighting between debt and equity and the capital structure to develop a WACC, weighted average cost of capital. Another recent enhancement is a feature that allows you to download the results of your analysis on the platform into an Excel file. Previously, that could be done on Word. It still is the case, but some people would like to have it downloaded into an Excel file, and that is now available. So that's highlighting some of the recent enhancements to the platform. Now, in the way of some core principles, I suppose we would call this, of the platform, it's all based on sound financial theory and empirical evidence. There's no stretching going on here. So it's credible, it's elegant, It's been designed by some of the IT folks over at BVR to have the user interface elegant and simple and workable, so it's not, you don't need to be a rocket science to operate it. It's also transparent. We provide the background calculations to derive certain information that you would use, and all those calculations are transparent here. One of the core philosophies of the information provided to you in the platform is it enhances professional judgment and not the other way around. We don't tell you how to use the data. We provide the data to you in a simple, credible, and transparent form, and then it's up to trained and experienced professionals to apply it in the way that they think, the way that they should. In the way of some background, I want to go through some things here. What you see at the top, of course, is a DCF model, and it says that the value of an asset, its intrinsic value, is all the expected future cash flows discounted back to the present value. Dr. Pablo Fernandez, who's a respected and pretty well published academic out of Spain at a business school in Madrid, Spain, said something that's interesting, and I think it's worth noting here. He says there in valuation there's a kind of a schizophrenic approach. Most authors admit for the numerator that there are different expectations of cash flows. Different people can have different expectation of cash flows. But then we get to the denominator. And most people view the discount rate as unique, and it's specific, and it's fixed. And the effort has to be done to get the discount rate to the nth decimal point. Dr. Fernandez describes the current state of affairs that the expectations of cash flows, the numerator, are formed in a democratic regime, and the discount rate is determined in a dictatorship. The message behind here is both the numerator and the denominator are estimates, and they're not specific calculations to the nth decimal point. Now, I want to talk just a little bit about the expected market risk premium, or otherwise known as the equity risk premium. A lot of people have lost sight of what this represents, and I think it helps to go back to the fundamentals. The market risk premium, or specifically the expected market risk premium in these cost of capital models, are the expected return of an average stock above the risk-free rate. The expected return of the average stock above the risk-free rate. So it's the expected market risk premium is what one expects to get by owning an average stock, specifically a market portfolio, above the risk-free rate. So many times this understanding has gotten into all sorts of technical details, and people have lost sight of what it means. And I think it's healthy, and I think it's important to understand at the core what we're doing here. Now, the market risk premium, and specifically the expected market risk premium, is unobservable. We cannot observe market investors' expectations of the future. We just can't do that. So we have to do something in its place to proxy for the expected market risk premium. Dr. Pablo Fernandez conducted a survey last year of finance and economic professors, analysts, and managers of companies. And of the ones located in the United States of America, there were about 1,300 respondents. So there's surveys of so-called experts. The average, the mean of the responses for the market risk premium is 5.4%. That doesn't sound too far out of what I think most business valuation practitioners believe. But take a look at the variation around that average. standard deviation is pretty big. And the minimum and the maximum, although they're outliers perhaps, it's pretty wide. So the market risk premium that people believe and they're using in their work are pretty wide. And to demonstrate the variance in all of this, and remember this is from the respondents of so-called experts in the U.S., we have an average of 5.4%, standard deviation of 1.7%, and if you remember much from your old statistics classes, that 95% of under the curve is about two standard deviations from the average. So take 2 times the standard deviation, 1.7, and add and subtract it from the mean of 5.4, and that tells you where 95% of the folks believe that the equity risk premium lies, the current equity risk premium at the time of the survey. So people believe that there's an equity risk premium out there, and there's differences of opinions among academics and practitioners. And all of this is because the equity risk premium is not observable and can only be estimated. Let's talk just briefly about cost of capital models. At the start, we often begin with a capital asset pricing model. It says the following, and I'm going to express this in as simple language as I'm capable of doing. It says that we can use this model to estimate the expected return of asset I as equal to what we would get by investing in a risk-free asset plus a risk premium. And the capital asset pricing model says the risk premium above the risk-free asset, the risk premium for specific asset I, is the expected average premium, or the premium above the average stock, multiplied by the beta of that stock. So in order to apply this model, you need 3 inputs. One is the current risk-free rate of return. That's the return that investors would get by investing in a risk-free asset. The second element that you need for this model is the expected return of the average stock above that risk-free rate. And the third element for the capital asset pricing model is the beta of the stock that's being valued, so asset I. So the beta is an adjustment to the premium for the average stock to make it from the average stock to the asset being valued. And beta subsumes all the characteristics of the particular stock in relation to the average stock. So if a company is small, if it's in a certain industry, it has unique characteristics attributed to that. All of those differences in characteristics between this asset and the average stock are subsumed in a single factor, and that factor is called beta. So we have one risk factor in the capital asset pricing model. Then we get to other kinds of models. In the business valuation community, a common one is the BuildUp Model, or acronym BUM. Now, a lot of people don't realize this, but the BuildUp Model is one form of the arbitrage pricing theory that says the expected return is a risk-free rate plus risk premium 1, risk premium 2, risk premium 3, and so on. In the business valuation community, you often see it expressed like this, that the expected return of asset I, which is what you're valuing, is equal to the current risk-free rate plus the expected premium on the average stock plus one or more risk premiums associated with that. And that might be size premium, industry risk premium, and so on. There's no uniform models there, but this is the general form of how people apply it in their particular circumstances. So that's the two main models that we work from, and there are variations of this: capital asset pricing model and the BuildUp model, models to estimate cost of equity capital. Now, all of this is well and good, and it's the business valuation community over the years has turned this into oftentimes all sorts of articles and mathematical models to make things more and more complicated. It's gotten, in many respects, complicated to an extreme degree. And for the folks on the call who are old enough to remember Rube Goldberg, that's what I think that we have in the business valuation literature and community with the practice, that we've built this very complex model, and it's difficult to understand, and it's inconsistent from one practitioner to another. Now, for the folks on the call who are younger that don't remember Rube Goldberg, if you have some time, do a Google on him. He was an engineer educated at Berkeley a long time ago, and he became a cartoonist. And his cartoons are quite humorous, but they basically take something simple and make something very complicated out of it. And I think there's an analogy between Rube Goldberg's cartoons and what has evolved in the business valuation community. What people want in cost of capital is something that's neat, simple, and one can look at it and figure out what's going on. That's what most people want. In reality, cost of capital looks like this in theory and practice. And we're trying to sort all of this out in a simpler way with this, with our platform here. So here we have the theory, the capital asset pricing model, the BuildUp model. You saw those earlier. They're relatively straightforward. They're easy to understand. But in practice and in theory, it ends up looking like this. So what we have are these models. Models are representations of the real world, and the real world is messy. And these are models, and they're not laws of nature. Now, some people try to take these models and make them laws of nature, such as the way to calculate gravity or thermodynamics and so forth. Those kinds of things work in the physical world, like in physics, the natural sciences, but they don't work in finance and economics because relationships between things change all the time, and they change all the time because humans are involved with that. So we take these models as a way to reduce and simplify our understanding of a messy world. So don't think that you can take these models and calculate a cost of capital out to the 5th decimal point. You can certainly go out to the nth decimal point, but that's not going to get you to the true cost of capital, not in economics and finance. So where we are, we have our theory, and then we have practice. And this is where we are today. And when we go to seminars and we read articles and so on, we have such a diversity in practice, different opinions, that things end up looking, as you see over here on the right-hand side. To illustrate this point on cost of capital a little bit more specifically, this is a text titled Cost of Capital Applications and Examples. It's authored by Shannon Pratt and Roger Grabowski. It's a notable work for the effort that they put into it. It's over 1,300 pages and in the 5th edition, and it weighs over 4 pounds. But despite the length and the effort put into this book, I doubt that it clarifies the misunderstandings and confusions about cost of capital. But cost of capital is hard. It's based upon a messy world, and I'm not sure that we understand a lot more about it today than we did 10 years ago or 20 years ago or what have you. So the best we can do is use the models and estimate required returns for cost of capital estimates rather than seeking to go out and calculate cost of capitals to the nth decimal point. Now, we use these models, and oftentimes in models, there's a lot of support behind this from the academic community, even going back several centuries to the ancient philosophers that are around. And they say that oftentimes we can understand the world better in simpler terms rather than more complex terms. And you may have heard this idea. It's called Occams Razor, or in the scientific community, it's the principle of parsimony. So it says the following, that the principle says the simpler solutions tend to be better than the more complex ones. Now, what's all this got to do with cost of capital? Well, what it means is more and more complicated mathematics in cost of capital does not necessarily get you to a better solution. And when you start introducing complex mathematics and more model inputs, it tends to generate signal, noise rather than signal. And what we want to try to achieve in cost of capital models is to determine what the signal is and filter out the noise. And the filtering is often done better with simpler solutions rather than more complex solutions in mathematics. So a model is an estimate of the messy world. Simpler models tend to do better than simpler models tend to do a better job at explaining a messy world. And this can be shown in computer simulations that a simpler model reduces errors compared to longer models. And the longer models can be, people are often fooled by them because they give the impression or the illusion of precision. So if something is more complicated, it must be better. That's not fact, it's a delusion. So with the platform, and I think all cost of capital models, these are estimates. And they're better done when done by professionals applying professional judgments. So professional judgment still matters in the world rather than computer calculations doing things for us of whatever, artificial intelligence or even something of calculating things from a database and so forth. So in our area of finance and economics, these are in the social sciences, not the physical sciences. There's no laws of nature, and we have models that are reduced in simpler portrayals of the real world. So in practice of business valuation, that almost all of the people here on the call, or all the people on the call, do is they apply professional judgment. And you want to keep professional judgment in your work, not out of your work. Professional judgment assumes that there's professional integrity and objectivity. It relies on principles and not rules, and not so much on relying on computers to make complicated and advanced mathematics to replace that professional judgment. So here with the cost of capital platform, there's no black boxes. Everything is transparent. We can't give you the raw data because we license it from CRISP at the University of Chicago. But beyond that, we make everything transparent so you understand what's going on and you can apply your professional judgment of how to take the information and apply it to your particular project. The data sources for the cost of capital platform is, number one, the University of Chicago Center for Research and Security Prices, acronym is CRISP, Dr. Aswath's DeMotoran's Data Library, and the United States Central Bank, the Federal Reserve. If you don't like this information and you have other information you want to use, applying professional judgment, you can override it in the system. The platform does not tell you how to, what you got to do, so you can override it if you want. Also, when applying unsystematic risk premium, the risk associated with a particular company, you can input that information in there as well too, however you want to come up with an unsystematic risk premium. Drilling down a little bit on specific inputs, the risk-free rate. For the Treasury rates, the T-bond rate, that comes from the University of Chicago CRISP database for Treasury returns after 1941. Now, the reason that it doesn't come from CRISP before 1941 is CRISP does not provide it because the T-bonds before that time had different characteristics than T-bonds since 1940. So prior to 1942, we obtained T-bond returns from Dr. Aswath Damodaran's data library, where he provides information on 10-year T-bonds. And then prior to 1942, to develop 20-year T-bonds, we reconstruct those by taking Dr. Damodaran's 10-year T-bond returns prior to 1942 and adjust them to 20-year T-bonds based upon the average difference between 10-year and 20-year T-bonds. The information we provide on risk-free rates based upon Treasury bonds, and we provide information on returns of 10-year T-bonds and 20-year T-bonds. Now, it has evolved in the American business valuation community to prefer 20-year T-bonds. There are some people in certain areas, different traditions, maybe other countries, that rely on 10-year bonds rather than 20-year bonds. We're not going to tell you one's correct and the other's incorrect, but we give you the information on 10-year and 20-year T-bonds, and then you get to choose using professional judgment what to apply. That's risk-free rates. Then we get to the equity risk premium. Okay, well, thank you. So we've covered the risk-free rates, at least briefly, about where the data is coming from and the information presented. Now let's get to the information provided on the equity risk premium. So once again, we saw this information earlier in a 2018 survey from USA respondents, where the mean is 5.4, but there's a pretty wide variance around that. So what does it look like from the platform? So this is the kind of information you're going to get from the platform. So just to highlight some of it, there's a historical approach. If you want to estimate the forward-looking equity risk premium, or in other words, the expected equity risk premium, and you believe that the past gives some insight into the forward-looking equity risk premium, we provide various measures of that. So in the first 4 rows, you see the historical difference between stocks and Treasury bonds. In the first 2 rows, it's the average difference from 1928 through the present time. Here it's presented as 2017. And the difference between the first and second rows is the average stock return compared to either the 10-year T-bond or the 20-year T-bond. The third and fourth rows, I've just highlighted another starting year. This one is starting in 1963. With the platform, users can input any year that they want. If they don't like starting back to the 1920s, they can pick some other period of time to start. So for illustration on this slide, we're starting with the average stock return in excess of Treasury bond returns since 1963. What you see over on the right-hand side are the arithmetic calculations based upon arithmetic means, and then a little bit to the left of those numbers, you see the geometric. Again, you get to pick which you want, arithmetic or geometric, and we're not going to tell you you should use one and not the other. And as a preview, there's arguments on both sides. So I know in the business valuation community, which tended to start with a lot of data from Ibbotson Associates, Roger Ibbotson advocated using arithmetic means. but there are others that advocate using the geometric means for these cost of capital calculations, notably Dr. Aswath, the motorist. And you can read about his reasoning in, I believe, the best place to look at that. You can find it online. Each year he does a paper called the Equity Risk Premium, updated every year. That's available on ssrn.com, Social Sciences Research Network.com. So you can take a look at Dr. Motorin's reasoning and arguments for using geometric. If you've been using arithmetic and want to know the arguments for one versus the other. Okay, so the first 4 rows are the historical approach, which essentially views that the forward-looking equity risk premium resembles what it's been in the past on average. Another way to estimate the forward-looking equity risk premium is with the implied approach. And Dr. Aswath Damodaran is perhaps one of the most well-known people providing this kind of information on a continual basis. I won't get into what this means in detail, but essentially what the applied approach says is that we're not going to look at history, that we're going to look at the current prices in the markets and try to tease out the equity risk premium from today's market prices. And Dr. Damodaran presents information about the implied equity risk premium in 2 different models, a standard model and then a model with sustainable payout. And there's a little bit of a difference that you can see on the right-hand side between the 2. So here we have the arithmetic over on the right-hand side, and then a little bit to the left, you see the geometric. Now, if you've ever looked at Dr. Damodaran's website for his implied equity risk premium, his numbers that he provides are geometric equity risk premiums. So they're geometric measures. So if you prefer arithmetic, we have converted Dr. Damodaran's geometric implied equity risk premiums to an arithmetic average. Now, we get into the idea of, well, which one's right, which implies the others are all wrong. And as I've tried to convey to you earlier in this web seminar, is what we're doing is not precise calculations to the nth decimal point. We're estimating things. We're not calculating cost of capital. We're estimating a firm's cost of capital. And the core reason, once again, is it's unobservable. And the best we can do is try to estimate it rather than pretend that we're calculating it with the illusion of precision. So the people who say, well, which one's right, just tell me which one's right and I'll reject the others as being wrong, that kind of argument ends up as what you see here. And if you can't tell what this is yet, these are angels dancing on the head of a pin. So the arguments about one way is right and the other ways are wrong end up being arguments about how many angels can dance on the head of the pin. I submit to you folks for consideration that if you get away from viewing cost of capital as precision calculations of applied mathematics and get back to the idea that these are estimates of unobservable measures, you'll pay more attention to what's important and less attention to esoteric ideas of arguing about the number of angels that can dance on the head of the pin. So to dive in a little bit more deeply with the equity risk premium, there's the historical approach and the implied approach, and then there's some other approaches I'll get to in a minute. So let's talk just a little bit more deeply about the historical approach. So this methodology observes the historical returns of, number 1, the risk-free assets, and number 2, the stock market. And it calculates the difference between the return on risk-free assets and the return on the stock market. The average difference between those two kinds of investments is taken to be an approximation of the forward-looking equity risk premium if you use the historical approach. To put it another way, by taking the average difference between a risky stock market and a risk-free asset, you take that approach, you're assuming that the future will resemble the past. But which version of the past? Because these averages, the historical equity risk premium, changes over time, and sometimes by a lot. So you are making that assumption that the future will resemble the past by taking this historical approach. But you need to be thinking about, well, which version of the past will indicate what the future looks like. So not to get into mathematical models, this is what's being done in the various platforms, including this platform, to calculate a historical equity risk premium. So it takes the average return on the risky stock market, subtracts it from the average return on the risk-free asset. And the difference between the two is the extra return risky stocks have provided above a risk-free asset. And that's the number you often see in this approach. And the assumption that you make if you use the historical approach is the future will resemble the past. So here's an example of the approach. Assume that the S&P 500, which is a proxy for all risky stocks, has had an average annual return of 10% in the past. Also assume that T-bonds, which is a proxy for a risk-free asset, has had average annual returns of 4% in the past. From that information, you can say that investors in the risky stock market in the past have earned an average of 6% more than they would have if they had invested in risk-free assets. And then as a business valuation practitioner, you make an inference that the average extra return of 6% in history gives you some insight about what investors expect it to be in the future. Is it right? I don't know. That's forward-looking. We can't predict much about the future except two things. And remember what those are? Death and taxes. Equity risk premium was never in there. So that's the historical approach and a little bit of context about it. Then we get to a second way to estimate a forward-looking equity risk premium in cost of capital models, and this is the implied approach. And I gave you a highlight of that a moment ago from Dr. DeMotorin's information that he provides on a regular basis. And he has this all documented in a paper, which I've highlighted here. And you can get that online. It's free. It's at ssrn.com. And he updates this paper once a year. And in that, he goes through his methodology of how he estimates the equity risk premium he believes to be implied from the current market prices of assets. So the core difference between the implied equity risk premium and the historical equity risk premium, the key difference between the two is that the implied equity risk premium, at least in theory, takes into account the current conditions today, whereas the historical equity risk premium takes into account the conditions in the past to calculate an average, as if the average would be repeated in the future, at least in the long run. So once again, here's the information that's kind of information that's presented on the platform. At the top is the historical approach using different time periods and using different maturities of the T-bond, and at the bottom, the implied approach using two different models from Dr. DeMotorin. Now, there are other ways to estimate equity risk premiums. One other way is to survey experts, and if you want to go down that path, Dr. Pablo Fernandez conducts a survey of practitioners and academics on a relatively regular basis and publishes the results of his surveys on ssrn.com. So if you want to do that, go to ssrn.com and search on his name. So far we've talked about the historical approach, the implied approach, and now the survey of experts approach. Another way of estimating equity risk premium, and this has become somewhat common in the business valuation community of practitioners. It's commonly known as the supply side equity risk premium. Now, this approach came about from Roger Ibbotson and a collaborator, Ping Chen, in a paper that they published about 15 years ago. And I've given you a reference at the bottom of that. And this supply side equity risk model is sometimes known as the Ibbotson and Chen model. At one time, this was covered by the curriculum for the Chartered Financial Analyst exam, and I don't believe that they cover that anymore, although I may be wrong. Essentially, what this kind of model does is it takes the current or relatively recent macroeconomic measurements and estimates what the forward-looking equity risk premium is. Or say that another way, it's taking current or relatively recent macroeconomic factors to estimate what the extra returns of the stocks would be above the risk-free rate. This is somewhat complicated to explain and even more so to try to understand. And if you want to learn more about the mechanics of it, take a look at this paper. I would say that if you had to explain your use of the supply side equity risk premium, other than saying, well, I got it from this source, if you had to explain how it works, it's relatively difficult to explain that in common language. So if you haven't looked at it yet, take a look at this paper that I've given to you at the bottom. So far we've covered the risk-free rate and we've covered the equity risk premium. We'll spend a little bit of time on the size premium. So the idea that smaller firms outperform larger firms came about by an academic by the name of Bands, who published, whose paper was published in 1981, and it was sort of corroborated by Fama and French in Fama and French's famous paper published in 1993, which is the foundation of their three-factor model. Now, since that time, you have many other studies, and I've given you three here, the three on the bottom, that have basically said that the size premium that was observed in the past isn't around anymore, or it's diminished. And the time that it diminished, according to some of these research papers, are in the early 1980s. So essentially, the story goes is once investors figured out from the Bands paper that they could invest in smaller stocks to get higher returns, a lot of people plowed their capital into smaller stocks. That increased demand, and that reduced the return since the early 1980s. So this is at the core of the debate, which all or most of you have seen, of whether the size premium's around anymore. And the research goes to listed stocks, traded stocks. And the real question mark is, okay, even if it's disappeared or diminished in the traded stocks, what about untraded, privately owned firms? That's a different story altogether. So regardless of your belief of whether the size premium in listed firms exists or whether it's diminished or disappeared, we provide data to you, and you can make your own decision and apply it in your valuation project. So I want to highlight the platform information that's provided to you. There's two measures of a size premium. One measure is the extra return of the risky stock market above the S&P 500. And the second measure is that amount adjusted for the CAPM beta. And that's called the beta adjusted size premium. I don't have time, and this is not the forum to talk about the mechanics of all that, but I do want to highlight the general approach and how the numbers come out. So at the bottom, you see some information that's coming out of the platform. If we take the general idea is to determine the average return of the smallest decile stocks and subtract the average return of the S&P 500. The difference between the average S&P 500 stock and the decile 10 average return is a size premium for the 10th decile. So those are your three columns. Now, I want to point out something. We've got three different time periods. One starting back in the 1920s, another one starting in 1963, which is a common starting point for a reason I won't go into in the academic research based upon database availability. And then the third row is the information from the early 1980s, which is starting in the year after bands documented the size premium, as I discussed. So here we have the decile 10 returns, and what you see is the average decile 10 returns have declined over time, or at least the time periods that we have here. The S&P 500 has varied a bit, but not all that much, other things being equal. And then the difference between the two is the size premium you see on the right-hand side. So what you see are the small firm stocks, average annual return has declined over time. And in fact, from the 1920s to 1950, the average return of the decile 10 stocks was around 34% average per year. And I don't think anybody believes that decile 10 listed stocks are going to be returning around 34% per year on average over the long run. So if you're using size premium data back to the 1920s, you're using those years in which the size premium was really high. And if you use more recent information, even going back several decades, you get a different size premium. Which is right? Well, that's where you start getting into the arguments of how many angels can dance on the head of a pin. So we provide the information to you. You apply professional judgment. It's your choice. Now, this is the first measure of the size premium relative to the decile compared to the S&P 500. The second measure provided by the platform is taking that decile size premium that I just described and adjusting it for the capital asset pricing model beta. Now, most people are actually in the business valuation community, the American business valuation community, most people are used to seeing this measure, and maybe they understand what it is or isn't. But essentially what this measure, the beta adjusted size premium, sometimes called the size premium in excess of CAPM, is it's a determination of a historical size premium, a determination of a historical size premium throwing CAPM beta into the calculations. So the platform provides that information to you. You see the three columns here, the size 10 size premium, which you saw from the preceding slide. Then you see the decile 10 beta over these time periods. And what do you see here? You see a pattern in the beta for decile 10. It's declining over time. In fact, over the last 35 years or so, the beta of decile 10 has been the same as the the biggest stocks in decile 1. And that's what the data shows. So if you take the S&P 500 base size premium, adjust it for beta, you end up with a smaller size premium. And it's smaller because the use of beta is often greater than 1, and it siphons off some of the size premium into the beta. Now, which do you use, the beta adjusted size premium or the S&P 500 size premium? That's up to you. That's up to professional judgment. So here it is again that if the decile beta is greater than 1, using it tends to siphon off some of the extra decile returns above the S&P 500, and that's why the beta adjusted size premiums are lower than the S&P 500 size premium. Then we get to measures of firm size, and I have just a few more, a little bit more to go here, and then we'll be doing the demonstration of the platform. So let's talk about firm size. In the academic literature going back decades, market value of equity or market capitalization is very likely the most common measure of firm size in academic research when studying equity returns. And the academic studies show us that non-market measures of firm size, such as a firm's book value of assets, a firm's annual sales, number of employees, and so on, the use of non-market measures of size show no size premium in smaller listed firms not otherwise predicted by CAPM and beta. And I've given you a reference for that, which goes back some time. So the platform provides firm size measures based upon market capitalization and not any other measure of firm size that might be used, such as book value assets or sales, primarily because there's no academic evidence that these non-market measures are useful in predicting returns for firm size any more than what beta might be used. The decile 10 returns that's provided by the platform, there's no subdivision of decile 10 returns. So some practitioners, they have in the past been exposed to alphabet soup for decile 10. Decile 10 A, B, C, or X, Y, and Z, or whatever, they have to be substituted or subdivided, I should say, of the decile 10. Let's take the smallest decile and then split it up even more. The concern that you should have in the alphabet soup of 10 A, B, C, X, Y, and Z is understanding that these are smaller firms. And they're smaller listed firms for a reason. And the academic research shows that the smaller firms tend to have poor profitability or cash flow problems or high leverage or a combination of the two. So if you're using decile X, Y, Z, subdivisions of decile 10, you may be looking at average returns of firms with poor profitability, cash flow problems, high leverage, and so on, and not taking that into consideration and using that information as a benchmark for your firm. So I've given you a academic research paper going back some time ago that describes the firm characteristics of smaller listed firms. And here are some references. I had some earlier references not shown on this list. If you happen to want some of those other references, contact BDR and they'll get in touch with me and I'll send you the references. Won't send you the article because of licensing, but I'll give you the full reference to those other articles if you're interested. Ron?
Thanks, Mike. Very well done. We're now going to move into a demonstration of the platform. And I'm going to show you, if you go into My BVR and you get to your license subscriptions, one of those will be the cost of capital professional that you can see here. And you click on that page and it brings up the the initial input screen that you can see. What we're going to do is spend a little time putting some information in, looking at some of the alternative choices that Mike expounded on, and show you a little bit of the utility, including some of the enhancements we've made since the first webinar that we did on the platform. And before we go into input some actual data, I'm going to go to the tab at the top here that says User References, and you can see one of the choices there is the Frequently Asked Questions, the FAQs. I'm going to click into that, and I'm going to just spend a little time going through these. I would suggest that if you're getting comfortable with the platform, a good place to start is getting comfortable with the information that's provided in these frequently asked questions. And you'll see right at the top here in the thank you line that there's a phone number and an email that if you can't find the answer you're looking for in the information that we're going to be scrolling through here in just a minute, you should reach out to the team at BV Resources. They're dedicated to trying to find the answers and to help us evolve the platform to make it as useful as possible, consistent with the tenets that Mike expounded on, to keep it user-friendly, transparent, and give the user the flexibility to make their own choices on the data points that they select to input in any particular application of the product. If we go down through some of these screens, you can see that all of the legends for the general information are described. There's information on the risk-free rate and the choices that you have between the 10-year and 20-year Treasury bonds. And then consistent, and we'll see this when we go into the actual demo, that you have the ability to put in your own risk-free rate if you choose to use something that you want to use on any particular assignment. The legends for the equity risk premium likewise are described here in terms of the choices. The CRIS data that we've gained access to is, I look at it as somewhat the default for at least the way we use the product, but I'll also point you to the DeModern choices, and those are described in more detail a little further on in the FAQs, and you can drill into Dr. DeModern's website itself to get an abundant amount of information on, you know, what is an implied ERP in his definition. So they're described here because these are the choices in the input screens that you have. And like the risk-free rate, you also have the ability to put in your custom ERP if you choose to do so. And it seems like in many instances in the past, I've seen appraisers that have been, you know, looking at using just say a 6% ERP because that's kind of the way they choose to build up their rate. You can see we have next the legend for the size premium information, talks about the deciles, and it gives the other description of the other information that's included in that, and we'll see it when we go into the demo in terms of the counts and the returns and the returns as well. So those are the legends for the input of the information. There's also a number of FAQs. We continue to add these as questions continue to come in to BBR, and we listen to our advisory panel and others. You can see here that this question, what is the source of data used in the cost of capital professional platform? For the risk-free rate information, you can see that we get it directly from the Federal Reserve, and there's a link right on that answer there that you can go into the Federal Reserve website and drill down and look at the source of that information as directly noted on the Federal Reserve website. Likewise, for the CRISP data that we get from the Center of Research for Security Prices from the University of Chicago, there's a link to go into that CRISP website and look at the information that they have about the history of CRISP and how it evolved. It's rather interesting reading if you have time to explore it. I did see a question as Mike was talking about whether or not folks could gain access to some of the other CRISP information, and my sense of that, and I would ask if Mike has any clarification, but that there's a license fee involved to have access to it, and I don't think it's likely going to be cost effective for any practitioner other than maybe the large firms to have direct access to the CRISP data. And I'm just trying to be responsive to the one question I saw, but you can go in and explore what the CRISP data is and how it's calculated. Likewise, and I mentioned this just a few minutes ago, on the implied ERP and the other information that we have sourced from Dr. DeModern, you can go into his data library, which is extensive, and if you haven't been there, be prepared, buckle up, because there is a lot there. There's some really good white papers that he's produced over the years. He's been very sharing with his information, so that's a good source of information to look at. I'm not going to go through all of these, but you're going to find answers to questions. I saw a question here, why is the start year in our platform 1928 versus 1926, which was what was used initially by Dr. Ibbotson and has been carried forward with other alternatives. And we've tried to be consistent with our data, and we struggled with being able to go back to years earlier than 1928. But the difference between going back 90 years versus 92 years on the average returns is insignificant, and that's just talking about my opinion. But I know when you're a rebuttal expert and you're comparing what you get from our platform to maybe someone else that's used a 1926 starting point, that it's a small amount of apples and oranges, but it's really an insignificant difference. And you can verify that by replicating a BuildUp or a CAPM rate calculation using the platform, using a 1928 start date, and using all other factors that are equivalent to another expert's development of a rate, and you'll see that the difference should be very small. The information's updated periodically. The risk-free rate information is updated from the Federal Reserve every day. The CRISP data is updated quarterly. Dr. DeModern's data is updated at least annually. We've shown some information on the size premium. I'm not going to, and again, I'd tell you to spend some time reading through these. There's a lot of information that we think is very helpful for folks to see what's going on with this. There's a question here: does the cost of capital platform include subdivisions of the 10th decile for the smaller listed firms? And we've talked about that, but we've decided not to go beyond the 10th decile. We just don't think it's appropriate, and so that's just the position that we've decided to take. I'm looking at what else here. For the sake of time, I want to make sure that we move along. There's information here about geometric versus arithmetic returns, and there's a choice you'll see as we go into the to the demo in just a minute, where you have the choice to use arithmetic versus geometric. For example, here's a question: are there any online resources for company-specific risk premiums? And that we have a link here to the Butler-Pinkerton calculator that's also available through Business Valuation Resources. That is a nice resource to help validate the professional judgment that many of us have to rely on for our unsystematic risk, whether it's just company specific or inclusive of industry as well. We'll see how you can save your calculations. They're retained in the program for a year. So keep note of that after a year they may get purged. So it's easy now with some of the enhancements to capture and download and save your calculations into Word or Excel in your own work papers, or directly into a report for that matter. So keep that in mind, that if you save your calculations here, that they'll be saved for a period of time. This last question is: can cost of capital professional be used for non-U.S. based companies? The information is coming from domestic returns on public market stocks and from risk-free rates on U.S. Treasury notes. So it's really geared towards the domestic U.S. market. There are probably ways to use cost of capital determinations under the platform for use in non-U.S. valuations by doing some alternate procedures with maybe bond rates between the U.S. and different countries, but that's beyond the discussion of where we're at today. I am now going to go into some user input, and we'll just start by creating a company here. I'm going to call it Acme. We're going to have a valuation date just to show you how the screens are flexible. You can click on the year, go back and forth to whatever valuation date you have. Let's assume we're valuing something and it's got a December 31, 2017 valuation date. We're going to start with the earliest year, which would be 1928. You can use a custom year. We talked a little bit, Mike did, about 1963 and the advent of the CompuStat data in 1982 and some of the academic studies. But you can use any year that you would like with the flexibility that the platform provides. So if we start with the earliest year and we're doing a valuation for 2017, we have the basic data input, and you can calculate the returns on the arithmetic or geometric basis. You just click the box and it'll calculate under either format. The default is arithmetic, which is what we've traditionally used. But if you, and I know Dr. DeModern is a little bit more of a fan of the geometric, but you have that flexibility. So you have the choice and the user flexibility. Once you've put in all the information in the blue screen, it opens up the tabs that you see here below. And the first choice you have is the risk-free rate. And consistent with what Mike said, you have the choice of a 10-year maturity or a 20-year maturity or a custom risk-free rate. And if you choose the custom risk-free rate, you could put in whatever's appropriate. You might be a continuing fan of the government intervention on rates and that they're artificially low. You could put in your own rate, whatever you think that might be, 3-4%. You can add notes that are captured. We're going to use, for sake of this first run through the demo, a 20-year maturity that comes directly from the Federal Reserve. In the closest date in the Federal Reserve data, even though we're doing a December 31, 2017 valuation, is December 29, 2017. Now that we've got that, let's go over to the ERP tab, and we can see the choices that we have here. I'm going to scroll up a little bit so you can see the choices. And you can see that we've got the crisp returns for the returns in excess of a 10-year Treasury bond and a 20-year bond average rate, or you've got the DeModern choices for the ERP. And again, we don't have time to go back in depth of what these are, but these are the calculations that you would find in his data library that you have direct access to. They load in here based on the parameters that we've input above. We're going to start with just kind of using, I think, the traditional build-up, and we're going to use, since we've used a 20-year the risk-free rate in the risk-free rate choice here, we're going to continue to use the returns in excess of the 20-year T-bill rate. Next, as we're building up our rate, we come to the historical size premium. Most people will see that this looks fairly consistent with what they've seen in the past from past SBBI books. You can see that you've got the 10 deciles, and then you've got the combined deciles, like the micro cap, as it's called, 9 and 10. 10 being the smallest. You've got, from large to small in the returns, and as Mike had on a couple of slides, you can see that you've got the size premium in excess of the standard S&P 500, and you've got the beta adjusted size premium. We're going to click on the 10th smallest, and you'll come back to see how we've got a size premium of 8 under the S&P 500 column and 5.64 under the beta adjusted column. So bear with me on this, and you'll see how those come into play as we get to the next tab, where we have the cost of equity now. And if we're using a build-up model, a traditional build-up model, you can see it's drawn in our risk-free rate that we've selected. It's drawn in our equity risk premium that we've selected. It's drawn in the 8% from the size historical size premium tab, and then we have the ability to add directly an unsystematic risk premium. We could add, say, 6% here, and we can see if we scroll down just a little bit further, we've got a buildup of a rate of 22.48%. Instead of putting in this 6% here, we could come down and we could say, gee, we've done some analysis, and we think that there's a 2% for the, let me see if I can get this in here. What am I doing wrong? Let's see.
Ron, I think you've entered 0 up there in unsystematic risk. I think you got to delete that.
Okay. Thank you. So I didn't erase the unsystematic risk column, so I've reset that to kind of a null number, and I've now put in a custom equity risk premium, and I can put in a specific company risk premium. I can get back to the 4%, break them out, we get to the same place. We can also use a beta adjusted size premium, but let's also go down and say, instead of using a traditional build-up model, let's use a CAP-M model. And you can see what we've done now is we've brought in the risk-free rate that we've selected. We've brought in the equity risk premium we've selected. And now we've done our research. We've gone to the industry betas that DeModern provides, or we've come to some other source, and I'm going to say we've selected a beta of 1.35% based on this particular assignment. You can see how that adjusts the equity risk premium, and we can add now a company-specific risk premium because the beta takes into account the size, And to be consistent, we're going to just say a 4% company-specific risk premium. So you can see, using a CAPM model, we now have a cost of equity of 20.19%. If we go to the next tab, and we're going to come back and play around with this for just a little bit, time permitting, but we've added this feature as one of the enhancements from the last iteration in our last webcast, where now you can take the calculations and calculate your WACC, and if you're going to need to, on your own analysis, determine what the debt to equity ratio is. But if we start with let's say 60% equity, it's going to make 40% debt. If we say our borrowing rate is 7% and we say our tax rate is 40%, it will come through and compute our WACC of 13.79%. If we come back and say, no, we've really got 80% debt, get this in here right, you can see how that will calculate the WACC based upon the parameters that you input. As you input these parameters, you can always go to the Summary tab, and it will give a recap of what you've calculated given the parameters that you've input. And here we're using the capital asset pricing model. If we were to go back to this tab and click the cost of equity, and we go back to the summary, you can see that now the summary has changed from the CAPM to the BuildUp model. So the summary will follow the choices you make in the prior tabs to come up with whether you're using a WACC model and whether you're using a traditional BuildUp or a capital asset pricing model. As you get this information calculated, you can press the copy button you see here and simply copy the information into a Word document. That's what I've done here. So you can capture each iteration that you have directly into a Word document for work papers, or maybe your report. If you want to then tweak the language a little bit, you can do that, but it'll take exactly what you've gotten out of the application itself. And here's a wrong item here. Excuse me.
Ron, I don't know about anyone else, but we got a black screen on it. Okay, there it is.
There you go. Okay. So you have the ability, as you calculate these items, you can save these iterations up here as whatever you'd like to save it as. I'm just going to go Acme C, because I have a couple of others. You can have screen notes, demo, whatever you want, and it'll save the entry points here. And then you can come back in, and I've done a number of these. This is the one I just saved, but if we wanted to look at a prior application, you can go back in, and it's now putting in another company. So as you have different matters going and you're using the platform, you can save those different matters and iterations of those different matters. The key is, as you come up here, you're going to want to save those with a kind of a consistent nomenclature. So as you call them up and your staff calls them up, you can come back in and you can see what you've done in prior uses of the platform. You can also download the data. So, and this is what Mike was talking about earlier. So now you can take the application and open it and put it into Excel. And here we have the demo B that I just called up from a prior iteration of the software, and you can see that it's now put it into 3 tabs of an Excel worksheet. This is the
Ron?
Basic information.
Ron?
Yes.
Yeah, I don't know about anyone else, but on my screen this is black, and I'm not getting the Excel spreadsheet.
Okay. Well, for some reason, it's not allowing us to show that part of it, so I apologize.
Hey, Ron, I think
for
you
that.
might just be showing your browser right now. That might just be the only application that you're sharing.
Okay. Well, can you now see the? Are you back on the cost of capital professional platform now?
Yes, we are.
Okay. For some reason, it's not allowing me to click on here. If you export as a Excel, it will export it into Excel with 3 tabs that will capture the information that you've input into a particular iteration, and then you can save that Excel worksheet as a way to capture your work and use it as you in work papers, however you see fit. So we've given you that flexibility to capture and export into Excel or copy into Word the information that we're looking at here. So I'm not going to try to play around with that, but we can try to answer some questions if we have on how that function works. But I would hope you get a general sense of how that's been added to the platform to give you that flexibility here, or down in the copy button that you can see down in the off to the right margin if you want to copy the data and cut and paste it into a document otherwise. We could go back into the platform, and we can go up into the data up above here. Let me see if I can get back to that. Where we could start with, and let's change this to 2018 December 31. We're going to use a custom year of 1963. We're going to select 2018. We're going to use arithmetic. We're going to come in and we're going to look at the 20-year risk-free rate. We're going to look at the equity risk premium, and now this equity risk premium is being calculated based on the horizon of 1963 to 2018, and you can see those numbers are lower than they were for the 1928 to 2017 that we used in the prior example, but that's coming directly from the data. You can also use the modern data that uses the same date range. If you go into the historical size premium now and you look at the size premium, and again for the 10th decile, just to have a comparable calculation using that shorter time frame from 1963 to 2018, you can see that we get a lower equity risk premium, a lower size premium, which is directly calculated from the CRISP data. If we put in a non-systematic risk premium of 6%, to just kind of show us our comparability, you get a 16.24% under the BuildUp model. If you come down and use CAPM, just to show you some flexibility, and let's say we come up with a beta of 1.1 for whatever reason, and a specific company risk of 5%. You can see how it gives you the flexibility to go either way. So this gives you the flexibility to make the choices throughout each of the items that you're selecting, each of the elements from the date ranges above to the choice of which model you're going to use to calculate your cost of equity, whether or not you're going to be using a WACC model that you're choosing, and any of that as you get done will end up in a summary that will allow you to capture all of the elements that you've selected for each iteration. And to me, what has been a great learning tool for me is to just spend an evening playing with the platform, going in and saying, I've got a valuation that I've just completed. I'm going to try to replicate what we've used from prior resources to see if I get close and I get comfortable. Now I'm going to, say, okay, I want to redo this and use a WACC rate that I didn't use before, and just get comfortable with understanding the flexibility of the platform and the control that you have once you get comfortable with understanding those choices, the control you have over, you're the one that gets to control the data choices. And they all come from what we believe are reliable sources that have great integrity. The getting into the DeModern's work has been an eye-opener for me. I've been a follower of Dr. DeModern for years, and now all of a sudden I have an appetite to get further into his work. And with that, I've got an eye on the clock here, so I'm open for some questions, and I can turn it back to Mike and Adam to see if we have any questions from listeners.
Okay. Hey, thank you, Ron. I really appreciate that demo. That was excellent. So we do have some questions, and I will just go through them in the order that they came in. So the first one here is more of a comment, and I guess I'll just read it and see if you or Mike have any responses to it. It says, I think the assumption being used for risk premium is that historical data is what investors use to estimate future risk premium. Whether it proves ultimately to be accurate or not is not relevant. Valuators have to put themselves in the shoes of market participants.
I guess the only comment I have is when you take a look at Pablo Fernandez's survey of academics and practitioners, the so-called experts, well, they can't agree on it themselves. And when you throw in Joe Investor, that's probably going to make the variance even more. So whether it's whether Joe Investor and the institutional investors believe it's 5.4% or some variation around that, who knows? But the best we can do is estimate it, and it's going to be up to professional judgment to make that call. This is not going to be scientific of saying that the future is going to resemble the past with precision to the nth decimal point.
All right. So the next question we have is, have you ever observed a successful argument that an appropriate ERP is some blend of historical and implied?
Specifically, no, but I know that when Jim Hitchner does this kind of work and makes his presentations, oftentimes he'll take an average of the different measures. So if you want to apply that thought to the equity risk premium, that approach would be, instead of checking off one of the measurements that's offered, is perhaps take an average of what's offered or some subset of that.
Okay.
I'll add a little bit there if I can. Jim Hitchner, in prior editions of his financial valuation and litigation expert newsletter, has done some analysis where he's calculated cost of capital under a variety of premises, including historical and supply side theory, to show that in the end you end up with maybe 150 basis points difference between using six to 8 to 10 different build-up models, and so it kind of, and the supply side kind of takes in a little bit of the implied in my mind. It's not directly correlated, but it's kind of a forward-looking approach versus the historical approach.
Yeah,
Okay.
and just to extend on that, when you start saying which one's right, which one's wrong, and then what Ron just alluded to was Jim Hitchner's demonstration in his newsletter, that they all come out within a reasonable range. What's left is arguments over how many angels can dance on the head of the pin, or arguments about this way is right and the other ways are wrong.
All right, guys. So the next one is the size risk premium based on market cap?
Yes.
All right, I know you guys covered that one, but just wanted to read them all. Okay, so the next one is, will the program iterate the weighted average cost of capital?
No. You'll have to come up with your own weights. So the inputs are input the weight of equity. It will calculate the 1 minus the weight of equity to come up with a weight of debt. But the platform, you'd have to determine the weight itself. There's no separate calculation to do iteration.
I would tell you, though, that the platform lends itself to the iterative process because you could have it up and open, and as you're coming up with your conclusions, you can look at where you're coming out, and if your weighting isn't proper, you can just adjust, you know, the proportion of equity and debt until you kind of get it kind of squared in, as opposed to having something that's automatically going to go through that iterative process. I know Harold Martin, who is a member of our advisory board, has I think an Excel model that does that iterative process and I'm not sure where that can be available, but it seems like the platform lends itself to kind of getting that dialed in as needed.
All right, so we received a couple questions about this, and they're kind of all just different variations of the same thing, but basically it's, you know, what start year should I select? Should I use the earliest year available?
Well, that's where we get into, we're not telling you what you should and shouldn't do. So presumably the business evaluators are trained, they're competent, they have some experience. So that's going to be a professional judgment that the practitioner is going to need to make themselves. We're not going to say one thing is right and the other thing's wrong. We've specifically have avoided doing that. Professional judgment is at the core of this work, and we're not going to go down the path of telling people what to do so that professional judgment's not being used. So perhaps that question is something that can be a topic for one of the seminars or the conferences coming up by one of the associations, and people can debate that and form their own conclusion and make up their own mind.
Okay, that makes complete sense. And this is maybe another professional judgment answer, but the other question I've been getting, should we use geometric means or arithmetic means?
Same thing. So if you read the old Ibbotson Associates, and I think I said this earlier, Roger Ibbotson argues that arithmetic means should be used for these purposes, and Dr. DeModern argues the geometric. They both have their reasons, and I think that there's a room for discussion on that. So another professional judgment, I would suggest that you read the reasons and make up your own mind.
All right. Okay, so we have another one here. It says, so the data goes back to 1928. The question is, why does it not go back to 1926?
The short reason is, and the core reason is we've integrated the platform with CRISP data and with Dr. DeModern's data. And Dr. DeModern starts his data at 29, rather than 1926. So it really gets messy from a technical perspective to show 1926 when there's going to be an absence of the DeModern data in there. So to keep the platform elegant, simple, and smooth, as Ron tried to show, we just had to align the CRISP data with the same starting point as Dr. DeModern in 1929. But I think that Ron said that if you throw out, you know, if you get a long-term average of 90 years versus 93 years, you're not moving the needle very much. So I think this issue of starting in 26 versus 1929. If that's creating anxiety for you, I would suggest that you look somewhere else and spend your time somewhere else, because throwing 3 more years into a 90-year average just isn't going to move the needle very much, and your time is best spent on somewhere else in the valuation.
Okay, so the next one, do you think the start date of returns should be considered on a case-by-case basis? Would you consider different start dates for different engagements?
To me, that's a professional judgment question. The professional should be making that decision, not us.
Okay. So are there any frameworks available to help estimate company-specific risk?
Let me take this one, Mike. We've got the Butler-Pinkerton model that's access to one of the FAQs, which is one source, but there are some nice frameworks that are articulated in the treatises. Gary Trugman has a great chapter, I think it's part of his chapter on cost of capital, where he has, I think, 8 different risk areas that can be used as an analytical framework. There's lots of examples of things. In the end, those analytical frameworks are just going to be tools that help support an expression of professional judgment. Everybody's been looking for, since the beginning of time, of cost of capital for kind of a formula for unsystematic risk, but the frameworks are helpful, but they're not the end all.
Okay. Yeah, just to expand on that just a little bit, the usual textbooks that's in business valuation practitioner libraries, the Hitchner and Pratt and Trugman and so on, and they're just got a lot of information in there and try to analyze risk factors and try to put a measure on it. And over the decades, there's been lots and lots of journal articles on that. So long story short, this is a subjective area. You take a look at it as a professional. If you've been to business valuation school and got a certification, you've spent a lot of time already through that. So there's lots of resources in here, and you'll have to make those judgments on your own. And then, of course, we're just providing a place in the platform for you to do that analysis on your own and then put your own number.
All right, Ron, here's one for you. So in your demo, you are entering betas and industry risk premiums and also an unsystematic risk premium. Where are you getting those numbers, or where would someone go to come up with those inputs when using the platform?
Yeah, great question. There's lots of sources for betas, and there's lots of literature on how to properly select and get a beta in position to be able to use in a model like this. There isn't an easy source. In some jurisdictions really favor a CAPM model like the Delaware Chancellery. So others, kind of like get very uneasy with the concept of betas. There's beta coefficients in Dr. DeModerin's library, and there's some access to those as one source. But it's a broad topic, and there's professional judgment that's involved when selecting, and I'll call it massaging a beta to be able to use it like I did to say, when I just cavalierly said, let's put in a 1.1 beta. That's going to come from some side work.
Let me extend on what Ron just said. The one who wrote the question may be asking about industry beta, and we have provided a link to industry betas as compiled by Dr. DeModerin. So one way to estimate an industry risk premium is to derive it from an average industry beta. So you can go over to Dr. DeModerin's website. He has subdivided the U.S. listed firms into industries, and then you can read the table of the average equity, the average beta for the industry, and he gives levered betas and unlevered betas. So what one can do now, the platform does this already. So what one can do is input what someone believes to be an industry beta. Let's just call it 1.2, and the platform will convert an industry beta into an industry risk premium. And the mechanism to do that is documented in the FAQs. So you can get a source from of industry betas from Demoteran's website. You can get it from somewhere else. Input the industry beta yourself, and the platform will derive an industry risk premium if that's the way you want to do it.
Okay, Ron, so here's another one for you, I guess relating to the demo that you just did. It says, is the end date of the data adjustable? For example, if I want to do a valuation of a business with an as-of date of January 2011, is it possible to set the data end date to not use data post 12/31/2010?
Well, I'm looking at that same question, and if they're saying January 1, 2011, you know, you're going to get a answer for the cost of capital as of December 31, 2010. I don't think that's going to be fundamentally the same answer as what the cost of capital is the next day. You could always, as you cut and paste the output from the platform into your Word, and you want to massage that to say that it's, you know, the cost of capital as of January 1. I wouldn't have a problem with that. If you're actually looking for the cost of capital as of the end of January, then you can use that as your end date as opposed to the end of the December of the prior year.
I don't know if this addresses what the question writer was asking, but the platform has in there, let me go through an example and make it more concrete. If your valuation date's December 31st, 2017, the platform allows you to, with a pretty quick pull down, to let you decide whether you want to do the data through 2017 or the prior year, which would be 2016 in that case. So some people might believe that if a valuation's on December 31st, 2017, you can't use 2017's numbers because the data hasn't been published yet. Platform will allow you pretty efficiently to pull down the preceding year and go with that if that's the way you want to handle it.
All right, Mike and Ron, I know we've gone. Oh, sorry.
I was just going to say, I think we are moving towards a more real-time utility, though, because in prior years we had to wait till the SBBI book came out to get our updated numbers for our calculations, and now, you know, it's not precisely real-time, but we're closer to it with the platform and how it draws its numbers versus the old hard copy stuff that what we used only, you know, 5-10 years ago.
All right, Mike and Ron, I know we've gone over our time a little bit here. Is there any sort of final thoughts that you guys want to, you know, go over before we wrap things up?
I would just urge people to use the platform and send us your questions and your comments. Our ears are wide open, and we're looking to continue to make enhancements as appropriate.
The only thing I'll just add is to reemphasize a couple of points that I made earlier. Number one, cost of capital is not calculations, it's estimations. So if you get that idea that you're estimating something, don't have a lot of anxiety that you can't calculate it to the 5th decimal point. And different experts can agree or disagree about cost of capital. And you see that with the equity risk premium surveys of Pablo Fernandez. Second thing is, I think the platform is is relatively simple and straightforward, and then the idea of Ron saying go in and experiment with it. I think if you do experiment with it, you're going to see how the data changes over time, and that's going to give you some knowledge that you may not have ever had the opportunity to get before. Is the rates of return, the average rates of return change over time. There's no equilibrium out there that forces an equity risk premium or a size premium to gravitate on some point. It just doesn't exist. The patterns change over time. Take a look at the platform, experiment with it, and I think you will learn a lot from that, and that may help you end up doing a better job in business valuation.